Ladies and gentlemen, good day and welcome to the Q1 FY26 earnings conference call of Prince Pipes and Fittings Limited, hosted by MUFG in time. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference call, please signal an operator by pressing star, then zero on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Sumit Khaitan from MUFG in time. Thank you, and over to you, sir.
Yeah. Good morning, everyone. I welcome you all to the earnings conference call to discuss Q1 FY26 results of Prince Pipes and Fittings Limited. To discuss the result, we have from the management Mr. Parag Chheda, Joint Managing Director, Mr. Nihar Chheda, Vice President Strategy, and Mr. Anand Gupta, Chief Financial Officer. They will take you through the results and the business performance, after which we will proceed for Q&A session. Before we proceed with the call, I would like to mention that some of the statements made in today's call may be forward-looking in nature and may involve risk and uncertainties. For more details, kindly refer to investor presentation and other filings that can be found on the company's website. With this, I now hand over the call to the management for their opening remarks. Over to you, sir.
Thank you, Sumit. Good morning, and thank you all for joining us for our Q1 FY26 financial results. The presentation and the press release have been issued to the stock exchanges and uploaded on our website. I hope everyone has been able to go through the same. FY25 unfolded against a backdrop of considerable macroeconomic headwinds. The year was defined by persistent inflationary pressures, subdued demand across core end user segments, and a marked reduction in government infrastructure spending. These factors triggered caution inventory optimization by our channel partners in key markets. Amplifying these challenges was the heightened volatility in PVC resin prices, which exerted pressure on both volume growth and profitability across the industry. As we stepped into Q1 of FY26, the challenging demand environment persisted. The sharp correction in PVC resin prices led to inventory losses in the trade channel, which temporarily compressed our margins. Despite these headwinds, our volumes registered a 4% YOY increase to 43,735 metric tons, while revenue degrew by 4% YOY, reflecting the impact of a weaker realization arising from price fluctuations. In response to this challenging backdrop, we maintained a clear focus on reinforcing operational resilience and executing our long-term strategic priorities. Our deliberate efforts to enhance brand visibility, deepen the channel engagement, and accelerate marketing initiatives are beginning to translate into tangible volume-led growth. On the brand building front, we are expanding our consumer touchpoints across high visibility travel corridors. Our collaboration with Indian Railways for branding in premium trains has significantly strengthened our presence on one of India's most prestigious and widely viewed transport networks. These initiatives ensure that our brand is both visible and relatable to consumers wherever they travel. Simultaneously, we are executing planned capital expenditure to support our growth ambitions. Our eighth manufacturing facility in Bihar, which commenced operations last quarter, continues to operate efficiently. The phase 2 expansion at this plant is progressing on schedule and is expected to be completed by Q2 FY26, further augmenting our capacity to serve emerging markets. Innovation continues to be a cornerstone of our strategy. We remain focused on enhancing our product portfolio with innovative offerings while simultaneously strengthening our distribution network across regions. I'm pleased to share that our bathware segment, Aquel, has now expanded in the South region following successful launches in the North and West. In addition, we have set up dedicated teams in the East, reinforcing our ability to penetrate new markets effectively. We believe these strategy initiatives will further accelerate our growth momentum and contribute meaningfully to delivering sustainable value for all our stakeholders. Looking ahead, we are optimistic about a gradual recovery in demand, supported by the government's renewed thrust on infrastructure spending. Our strategic focus on geographical expansion, product innovation, and operational excellence position us well to navigate near-term market uncertainties and capture long-term growth opportunities. In conclusion, despite external headwinds, we are confident that our strong fundamentals, diversified product portfolio, and customer-centric approach position us well for sustained long-term growth. Thank you for your time. I will now hand it over to our CFO, Mr. Anand Gupta, to take you through the key financial highlights.
Thank you, Parag bhai, and good morning, everyone. I'll be taking you through the Q1 FY26 financials now. Our volumes for the quarter stood at 43,735 metric ton. It grew by 4% YOY. Revenue from operations stood at 580 crores, and EBITDA for the quarter stood at 40 crores. Margin is at 7%. Profit before tax for the quarter is at 5 crores. And in Q1 FY26, our working capital is at 93 days compared to 98 days from the last quarter. Receivable have shown an improvement and now stand at 55 days from 61 days. And inventory days is at 83 days as on 30th June 2025. With this, I open the forum for question and answer session. Thank you.
Thank you very much. We will now begin with the question and answer session. Anyone who wishes to ask a question may press star and one on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Shravan Shah from Dolat Capital. Please go ahead.
Hi, sir. Thank you. Sir, want to understand clearly revenue, volume, and EBITDA margin at least for this year. If possible, if you can help us in terms of the quarter-wise also. So let me put it my questions better. So first on the volume growth, so 3.7% growth we have done in this quarter. So in second quarter, how do you see the growth? And let's see the whatever the EDD comes by September or October. Then in the second half, how do we see and net for full year, how do we see the volume growth? Second, the biggest question is on the realization front. Though this quarter 7.8% kind of a decline is there QOQ, but if I look at from FY25, it is 9% decline. So in Q2, how do we see and in the second half? So net, I want to understand in terms of the revenue for FY26. It seems like we would be a kind of a 2-3% kind of a growth. So help me in that.
Yeah. So I'll take the first question on the volume side. So volume growth has been 3.7% for first quarter. In the second quarter, July has been to a good start, So we have seen good growth in July. And we are confident of high single digit to low double digit kind of growth should be possible for the rest of the year going forward. As far as realizations are concerned, I mean, everyone knows we are a pass-through industry. It's mainly a function of raw material prices which are not controllable. So if you see the decline in realizations year on year, June quarter to June quarter, I think we are in line with our peers of around 8-9% kind of a drop in realization. So I think that is going to be a function of raw material pricing. So whenever the duty is announced and the raw material prices move up, I think realizations also will move in line with that.
But as far as Q2 is concerned, the current realization are likely to remain till the time ADD doesn't come. So currently, is there a way in terms of either by increasing the CPVC share or whatever way, whether the Q1 was very bad in terms of products mix or anything? So do we see any kind of a realization improvement possible except the ADD in Q2?
Yeah, I think the other way of improving realizations is through product mix. Even in first quarter, we have had a better growth in CPVC compared to PVC. So as product mix improves, realizations also will improve.
Okay, and now on the margin front, so how do we see the 6.8% kind of EBITDA margin? I understand we used to guide 12% kind of a sustainable long-term EBITDA margin, but for this year, till the time ADD doesn't come, do we see even kind of a 8% kind of a margin is possible, or this number will be there?
No, so I think margins will improve going forward. We have seen an inventory loss of around 15 to 20 crores in the June quarter. Inventory losses going forward will not be there. And as volumes improve, operating leverage also will improve. So I think in terms of margins, Q2 will be better than Q1, and the second half of the year will be better than the first half.
Okay, great. And last on the capex front, sir, so how much cash capex we have done in Q1? And for full year now, last time we said 220 odd crores. So for Actual and then remaining on the Begusarai, how much is left? And currently the Begusarai capacity last time what we said 24,000 ton, and now by September will it reach to 60,000 ton?
So on the first part, the capex is in the first quarter is around 75 crores, and for the rest of the year, including Bihar expansion, it will be in the range of around 160 to 170, which will take care of leftover of Bihar, which will close by 30th September. And the second part is actual commitment, which is still there, which is pending, which we have factored in our cash flow projection. And then the rest is operational capex for the rest of the plants. In terms of Bihar reaching out in H1, it will be close to 60,000 tons of capacity will close by 30th September.
Okay. Thank you, sir. I have questions. I will come in queue. Thank you.
Thank you. The next question is from the line of Sneha from Nuvama. Please go ahead.
Hi, good morning, team. Just a couple of questions from my end. You did mention the inventory loss number, but could you also quantify other reasons, like, what has been the loss from the bathware segment, and, where do we now see the margins going ex of inventory losses?
So bathware loss is close to 5 crores, which translates to 0.8 to 1%. So that is the other number. And going forward, as Nihar mentioned, that from Q2, margin will start improving, and the H2 will have a normalized kind of EBITDA after factoring bathware loss.
Understood. The second point was you also mentioned inventory days is standing at about 81 odd days. Could you quantify that, how much would be the inventory for raw material as well as finished goods here? And what's your target to, for inventory levels next quarter or the year end?
Yeah. So inventory actually has reduced from March end to June end. So I will give you the exact numbers in terms of days. In March, raw material was around 45 days, which has come down to now 35 days. So we have seen a reduction of 10 days. I think the target here would be to keep this around 30 days. So we are close to our target. We have seen a sharp reduction in the past quarter of around 10 days. Finished good in March end was 35 days, which at June end is around 40 days, which is a 5-day increase, which is we are okay with because we are gearing up for better demand going forward. So in terms of the target that you asked, I would like to keep it between 70 to 75 days. Around 30 to 35 days of raw material and balance finished good.
Understood. Thanks, team, and all the best.
Thank you. A reminder to all participants, you may press star and 1 to ask a question. The next question is from the line of Keshav Lahoti from HDFC Securities. Please go ahead.
Hello. Hi. Thank you for the opportunity. Sir, as you highlighted, the CPVC growth is better. So earlier it was growing by double digit highlighted by you. So should we expect the CPVC volume growth was double digit in this quarter also?
I think it was, I will stay away from giving exact numbers, but it was high single digit.
Understood. Got it. And sir, how are the trends on the incentive side in the market? Has it changed? Has it increased, decreased? How is it? What sort of higher incentive you are giving to dealers now?
I think sentiments in the channel are better than what it was in the previous quarter. So we have not seen very sharp decreases in PVC. There have been decreases, but it's not been very sharp the way it was before. And I think PVC prices have bottomed out, if not close to bottom. So I think sentiment of channel is only improving. So, it's not an on and off switch. We can't just pull the trade incentives, but we have started rationalizing where required. And where we think that we need to continue giving the incentives, we are going to continue giving the incentives. So we need to find the right balance between, of course, improving margins, but today main focus of the organization is on improving volume growth and capacity utilization.
Got it. And sir, when we expect the ballpark number of 12% margin, whether this will be achieved this year or is it time to reach this number, a long-term target?
Can you say that again?
So normally company guides, in the long run, the EBITDA margin of the company would be 12%. So should we expect this by Q4 or is it possibly a 1 or 2 year away?
No, I think by Q4 we should be normalized, if not by Q3.
Understood. Got it. One last question, sir. You haven't mentioned bathware revenue yet, right?
Just give me 1 minute.
Yeah.
Net revenue for first quarter of bathware is 11 crores.
Okay. Thank you. I'll come back in flow.
Thank you. A reminder to all participants, you may press star and 1 to ask a question. The next question is from the line of Pranav Mehta from Equirus Securities. Please go ahead.
Yeah. Good morning, sir. Thank you for taking my question. Sir, I wanted to understand on 2 things. One is on the interest cost. So that has seen a sharp jump. So anything one-off there?
So we have capitalized majority of our Bihar project, and the term loan which was taken for that purpose was capitalized till the date we commence our production. Post that, it is now operational expense. So that's why you are seeing that difference in Q1 finance cost compared to last quarters.
So, sir, going forward, this would be a kind of a steady state interest rate for this year, or are we expecting?
Till we repay our term loan on a reducing basis, interest will be charged in P&L on term loan.
Okay. So my next question was this write back on the excess staff incentive. So exactly what was that?
So this is a normal cycle of evaluation based on company's performance. We have decided to incentivize our employees accordingly, and those write backs has come because of the lower profit company has made.
So sir, in that case, the quarterly number that you have posted for 1Q, will it remain at the same level for the rest of the year, or are you seeing some increase in that?
No, I think no. So the performance-linked incentives are a reflection of the health of the organization and the profitability of the organization. Going forward, as inventory losses reduce, minimize, and overall product mix improves, I think margin from second quarter will be better than first quarter, and second half of the year will be significantly better than the first half of the year.
Okay. But staff cost more or less would be remaining at this level?
No, it will. No, the cycle at our end is July to June. So in Q2 you will see the increments coming in the cost of salary.
Okay. And so just to make it clear, all the inventory loss for the inventory that you have built up has been taken, right?
Yes.
Okay. So no further, as of now, as the prices remain, no further loss you are expecting?
Yes.
Sure. Thank you. That's my side.
Thank you. The next question is from the line of Udit Gajiwala from Yes Securities. Please go ahead.
Yeah. Hi, sir. Just a broad understanding as to the overall view, right? So is it the volumes that will be the key focus now, given that, there is a lot of competition also there, and all the other players have also, set up new capacities. So do you see that the pricing war will continue and volumes will be your key focus and you'll have to pay for the margins?
So volumes will be the focus. Focus has always been on profitable growth, so we don't want to have any predatory pricing. We had to have aggressive trade incentives when channel sentiment was poor, especially in December quarter and Jan quarter of last financial year. But I think as PVC prices are bottoming out, sentiment is improving. There we don't see a very high resistance from the channel to stock up. So I believe going forward we will be able to focus on profitable volume growth. And in our industry, especially for us, the way our cost structure is, operating leverage plays a big part. So the more we sell, the more profitable we will be from a cost absorption point of view. So I think the two objectives actually go hand in hand.
Got it, sir. And in your opening remarks, you mentioned that July has been good versus what you have seen in Q1. So can you point out that as to which segment you see the growth coming up, or a specific region if you would like to highlight?
Mainly from building material, because because of the monsoons was not a great agri season after, I would say, May and beginning of June. So mainly I would say driven by residential building material products.
Got it, sir. Yeah. Thank you, sir, and all the best.
Thank you.
Thank you. A reminder to all participants, you may press star and 1 to ask a question. The next question is from the line of Meet Jain from Motilal Oswal. Please go ahead.
Hi, sir. The question is regarding a more macro scenario. As we see, anti-dumping duty, which has been expected to come by around September, October. Until that, prices are expected to be stable around this level, as you have told in bottomed out. And in terms of demand, you mentioned that demand is expected to improve going ahead with increasing government push. So in which pockets are you seeing this demand recovering, in which locations? If you can just throw some light on that.
So I think, like I said, agriculture season was short-lived, which anyway is not a big part of our revenue. It's only maybe 30% of the overall revenue. Mainly, we are a building material company focused on plumbing and SWR. So I think growth will be, we have seen the green shoots of demand in July, and going forward, I think these are the segments that will continue to do well.
So basically, our demand will be more driven by higher launches of new residential projects across India and more capex from the private organizations, right? Then more focus on government infra.
Correct.
And 1Q, as we know, it's heavy on agricultural, but as a company, we are heavy on plumbing and FWR, as you mentioned. So 1Q, didn't we saw a good growth in residential?
So we saw, so agri is around 30%-35% of revenue, which is still a significant part of our overall revenue. But we are, I would say, in the industry, we are pretty well hedged between plumbing and agri, and followed by infrastructure. Okay.
So this 30% is for the entire year, or this Q1 is more agri-driven, hence it's 30%?
30% is on an annual basis. Of course, agri demand is seasonal. So you will see sort of March to June tends to be the large agri season, and in December you see a small agri season.
So this quarter can be at over 50% for us in terms of volume?
I'm sorry?
For this quarter, for 1Q, can it assume it will be over 50% this quarter because being a heavy season?
No, the SKUs are not that large.
Okay.
Yeah.
Okay, got it. I'll get back in the queue. Thank you.
Thank you. The next question is from the line of Utkarsh from BOB Capital. Please go ahead.
So my question is regarding the Bihar plant. So if you can just help us, what would be the capacity utilization of our Bihar plant in the June quarter, and at what level we expect to operate, say by the coming March quarter, and what would be our break-even point for our Bihar plant?
So first, the utilization part, we have to understand that the complete range has to be available at the Bihar plant to make sure that the whole set of delivery is done. So right now, as we have progressed to close to 58,000 ton, but the actual efficiency of these addition in the capacity will happen from Q3 once the whole range is ready. So right now we are building capacity, but the effective utilization will happen from Q3. Mid of Q2, I'll say, will start. So then we can better see that what is the effective utilization. The other part was related to when it will break even. So Bihar will take around 5 years to break even if we operate at close to 70% capacity.
So if I understand correctly, you mean to say that Bihar plant is going to negatively contribute at EBITDA level for the next 5 years?
So you said that when it will break even in terms of investment made, right?
So I was talking in terms of EBITDA level, sir.
At the EBITDA level from the Q3, Q4, it will start contributing positively. Because as we have now, Q1 and Q2 will happen mostly in the build-up of capacity. So the overheads which we have started incurring in terms of operational expense will not be absorbed fully. But once the utilization kicks beyond 40% plus, we'll start neutralizing our expense.
Okay. And so what is our net debt position at the end of June 25, and where do we see this at the end of March 26?
So net debt is around it's 100 crores negative, and you want March number as well. So I'll connect post this project.
So negative 100 crore. So that means you are having a net cash of 100 crore towards the end of March.
100 crores debt.
Okay. And sir, last question is that we are operating our existing plant capacity at a very low rate in the June quarter. So wanted to understand what is the need of maintaining such high level of inventory as it is creating a pressure on our return ratio profile. Usually companies stop a high inventory only when they are operating at a very high rate. So what is the need for maintaining such high level of inventory?
No, as I have said, inventory has reduced from March to June. So when inventories are high, in one quarter I cannot just directly reduce inventory. So if you see the reduction in inventory from March to June, we have seen a 10-day reduction in raw material, and finished good has increased by around 5 days. So I think 30 days of raw material and 35 to 40 days of finished good is an industry standard, because we have so many high range of SKUs. We have to maintain inventory, and a lot of new products also that we have launched. So if you look, 70-75 days is a industry norm.
Okay. And sir, just lastly, our ROE has got significantly depressed right now. So what kind of an ROE we are getting, say, over the next 2 to 3 year period? And to achieve that level, what we are assuming in terms of the EBITDA margin and the gross asset turn? Sir, if you can just help me out with this.
So long term, if you see, our return on capital has always been around 15 to 20%. The reason that the return ratios are under pressure currently is because of two reasons. One is, of course, profitability has taken a hit in the past few quarters, and we have had a capex cycle also play out over the past 2 years. We have put up a large amount of capacity in Jaipur, Telangana, and now Bihar, and as well as debottlenecking existing facilities. So as capacity utilization improves and as profitability normalizes going forward, we will see improvement of return ratios back into 10 to 15%, and then eventually more than 15%.
Oh, okay. Thanks a lot, sir.
Thank you. A reminder to all participants, you may press star and 1 to ask a question. The next question is from the line of Tushar from Omega Portfolio Advisors. Please go ahead.
Good afternoon, sir, and thank you for the opportunity. Sir, considering the capex deployment from the states like Gujarat, AP, UP, and MP, so for Prince, what sort of volume growth you are seeing, from these states or at the company level?
No, so all the 3 states that you talked about, we have a good market share, be it Gujarat, UP, or Telangana, Andhra. And we have a manufacturing facility in Telangana, in Silvas, which is a union territory close to Gujarat, and as well as Haridwar, which is Uttarakhand. So our supply chain is strongly aligned with the frontiers of growth, and we have seen good growth across these markets.
Sir, can you just quantify the volume growth you are expecting at the company level?
So I think high single digit, low double digit kind of growth can be expected going forward.
Fair enough, sir. And sir, in terms of your split, like plumbing would be what percentage, also the infrastructure would be what percentage of your revenue?
So around 35% would be 30 to 35% would be agriculture, 3 to 4% would be infrastructure, 1% is water storage, and balance is building material, which is plumbing and SWR.
Fair enough, sir. And so, like in terms of CPVC, like what would be the mix CPVC over normal PVC?
So CPVC, in terms of revenue contribution, has continued to move up. over the past 5 years. So it used to be around 15%, which now has gone up to around 25% plus.
Fair enough, sir. That was really helpful. Thank you.
Thank you. A reminder to all participants, you may press star and one to ask a question. The next question is from the line of Shravan Shah from Dolat Capital. Please go ahead.
Hi, sir. Sir, a couple of things. First, last time we said a 3% incentive that we paid to the channel, so that was also was there in Q1 full, and maybe we will be continuing with the same in Q2 also.
See, that depends. Like I said, where it's required, we will continue. Where it's not required, we will continue to pull it.
Okay, got it. Second, sir, in Bihar one, so last time we said we may look at 20 to 25,000 volume in FY26. So is it possible some indication in Q1 how much kind of whether it would be 3,000-4,000 kind of a volume was there, and this 20-25,000 is doable in FY26?
So can you repeat, Shravan?
I said from Bihar, last time we said that we are looking at 20 to 25,000 ton of volume in FY26. So any ballpark idea in terms of Q1 how much it would have contributed 3,000-4,000 kind of a ton, and for full year can this 20 to 25,000 ton from Bihar is doable?
So as I mentioned earlier, we have created a backup in Bihar in terms of capacity, which will start giving actual production from H2. So when we build up 60 KT, so technically we will have 6 months time to fully utilize. That means 30,000 will be available for us in H2, and H1 I can say that it will be close to 10 to 15,000, something will around that will be there. So taking the utilization 60 to 70%, we will be in the range of 20-25 KT from Bihar for the full year when we close FY26.
Thank you. A reminder to all participants, you may press star and one to ask a question. The next question is from the line of Keshav Lahoti from HDFC Securities. Please go ahead.
And thank you for the follow-up. So what was the ad spend for this quarter?
Ad spend.
It is in the range of 1.7-1.8%, a tad lower, but going forward we'll maintain for the full year around 2%. That is what we are seeing, but we'll see how the quarter goes.
Got it. Lastly, what is the bathware revenue target for this year, and when we expect to see the break-even?
I think break-even is around in 4 to 6 quarters.
Okay, 4 to 6 quarters. So you are saying towards the end of FY27, that is possibly got delayed earlier. We are expecting earlier, right?
Yeah, so I think it would be by mid of FY27. Because we have now started South and East. So there, once the revenue start coming in, that will help us reach the break-even point. So maybe, yeah.
And what is the revenue target for this year? Bathware revenue target for this year?
So we have done 11 crores in first quarter. As revenue starts coming in from South and East, and we improve in North and West, this will improve. So I think around 50 to 60 crores is doable this year.
Okay, thank you. That's it.
Thank you. A reminder to all participants, you may press star and one to ask a question. The next question is from the line of Shravan Shah from Dolat Capital. Please go ahead.
Hi, sir. Sir, in this Q1, at an industry level, what was the volume growth You said for CPVC was a high single digit, but overall combined would be how much growth? And for full year FY26, how do we see the industry growth? And possibly, will the CPVC will be a single high digit, or can it be a double digit growth?
So CPVC was high single digit for us, not for the industry. First.
So for industry was how much?
There's no, data collection like that we do on a quarterly basis. There's no official research. I think on an annual basis we can get better sort of numbers. But overall, I think industry was flattish in the first quarter.
Okay, and for full year, how much we see industry growth?
I think long-term basis PVC industry should grow all categories put together 6 to 7%. Over next 2 to 3 years, 6 to 7% per annum.
Okay, that is that understood. But for this year, given the even Q2 would be a very very marginal. So except the ADD if it comes by September, if possible, also you can also specify. Do we think that by September October ADD can come?
It's likely. I mean. I don't want to speculate, but yeah, it's likely by September.
But will it lead to a 3-4 rupees kind of a price hike, or it can be a 8-10 rupees price hike is also possible?
Extremely speculative. I think I would not, try to give any kind of a guidance on how much it will lead to. I think let the time tell.
Okay, got it. Yeah, thank you, sir.
Thank you. A reminder to all participants, you may press star and 1 to ask a question. The next question is from the line of Arun from ICICI Securities. Please go ahead.
Hi, just one thing, you mentioned July was pretty good. Just to understand, would we be on in the at least the high single digit kind of growth if we add the first 4 months of this quarter of this year?
You're not audible.
Mr. Arun, we can't hear you properly. Can you please be a little louder?
Yeah, we mentioned that that July was pretty good. So is it right to say that for the first 4 months of this financial year, we would be in the high single digit volume growth?
So I think we have already given our guidance around going forward, and Q1 numbers you already have. I think in the middle of the quarter, I would not want to speculate, but I think in terms of if I understand your question, I think the direction I have given, I think high single digit to low double digit growth for the year is possible, looking at where we are today and the kind of capacity we are putting up. I think that's a fair estimate.
Okay, and just to take it forward, we mentioned that Bihar will do 25,000 tons. If I look at last year numbers, we did 177,000 tons for the full year. So straight away, it's like 11, even if I assume 20,000 tons, 11% growth straight away comes to our numbers, assuming there's zero growth in our core business. So where I'm missing, the guidance doesn't match.
No, but I mean, overnight, the market is not going to, we are not going to open up a new market. So today, Haridwar was catering to East. Now, if you put up a plant in East, somewhere, we have to give it time. It's not that as and when I put up capacity that the market will grow as per my capacity. So if we put up a new plant in a new geography, it is bound that from the other plants there is going to be a part cannibalization in the first year. Only in the second or third year will we have a net that kind of an increase. So I hope that's clear.
So what I'm trying to get to is, if whatever you're guiding for basically means that even I assume your number at let's say double digit, it will be lower than what Bihar plant does, including cannibalization. So it's not matching up with what you're saying.
Yeah, I think, let me clarify that when I put up a plant in a new geography, today East, before the Bihar plant was put up, the Haridwar plant was catering to the East market.
Fair point.
It's not that we were not present in East at all, right? So when I put up a plant in East and I start serving from that plant, it's not that the market is going to grow as per the capacity I put up in the first year itself. So it's not that I had zero volume in East. I was serving it from other plants. So it's bound to happen that in the first few quarters, the volumes from the other plants will go down because I've put up a large capacity in a new geography.
Okay. Thank you. Thank you.
Thank you. The next question is from the line of Keshav Lahoti from HDFC Securities. Please go ahead.
So just a small follow-up. So just some color on July, how has been the volume growth? Maybe additionally, it's a low double digit or mid-teen double digit. How should we see?
I think the direction has been given, Keshav. In the middle of the quarter, I will stick to giving only long-term guidance or a medium-term guidance.
Okay, got it. That's it. Thank you.
Thank you.
Thank you. As there are no further questions from the participants, I now hand the conference over to the management for closing comments.
Thank you, everyone.
On behalf of Prince Pipes and Fittings Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.